Welcome back to Am I Catching a Falling Knife? The podcast where we cut through the noise to figure out if you're about to make a genius move or, well, catch a falling knife. Today, we're diving into a retail giant that's seen some interesting movement lately. WMT, or Walmart, which might make some of you wonder, what's driving this, and is there more to the story? Let's find out. All right, let's talk about the dominant narrative surrounding Walmart right now. The market is largely focused on Walmart's resilient sales growth. We're talking strong performance in grocery and e-commerce, especially as consumers become more cautious with their spending and gravitate towards value. Walmart's whole business model plays directly into that. However, it's not all sunshine and low prices. Investors are also grappling with persistent margin pressures. We're seeing rising costs, including tariffs, which are squeezing those thin margins despite Walmart's efforts to keep prices low. So, it's a bit of a tug-of-war between strong top-line growth and bottom-line pressures. So, what exactly is Walmart? For those new to the ticker, Walmart Inc. is a global behemoth in retail and e-commerce. They operate supercenters, supermarkets, hypermarkets, and even membership-only warehouse clubs like Sam's Club. They're not just selling groceries. They've got everything from health and beauty to home goods, apparel, electronics, and even financial services. It's a vast empire, primarily driven by their U.S. segment, which makes up roughly 79% of their revenue. Now, let's put some numbers to this narrative. How might these competing forces of resilient sales and margin pressures actually impact the company's bottom line? Our analysis starts with Walmart's latest annual revenue of about $680.99 billion. If we estimate a baseline quarterly revenue, that's roughly $170.25 billion. Given Walmart's TTM gross margin is quite thin, around 4.31%, that gives us a baseline quarterly gross profit of about $7.34 billion. Here's where the narrative comes in. Our model projects a modest 2.5% increase in total quarterly revenue, driven by that resilient sales growth narrative, bringing us to around $174.50 billion. But those persistent margin pressures are expected to chip away at profitability. We estimate a 20 basis point reduction in their already thin margin, bringing it down to 4.11%. When we multiply that projected revenue by the reduced margin, our projected quarterly gross profit comes in at about $7.17 billion. So, what's the net effect? We're looking at an estimated negative impact of about 2.24% on gross profit. Now, it's important to remember that Walmart's gross margins are incredibly thin, meaning even small absolute changes in revenue or costs can have a magnified percentage impact. This makes our estimation a bit sensitive, and we're using gross profit as a proxy for earnings impact, assuming other expenses scale proportionally. Let's shift to valuation. The current market price for WMT is around $96.05. When we run our discounted cash flow, or DCF model, we get a few interesting figures. Our base case DCF value, before accounting for the specific narrative adjustments, comes out to about $51.69 per share. However, when we factor in the narrative's impact, those slight revenue gains paired with the margin squeeze, our narrative-adjusted DCF value drops even further, to approximately $48.82 per share. If we look at another common metric, the PEG ratio, which relates price to earnings to growth, it suggests a fair value of about $37.09. What all this tells us, friends, is that the current market price of WMT, sitting north of $96, appears to be significantly higher than all our calculated intrinsic values, even after accounting for the positive aspects of the current narrative. For those of you wondering about potential entry points, if you're keen on Walmart, our custom buy levels to watch would be around 90, 80, and possibly even 70. These are points where the valuation might start to look more attractive based on our models. So, to wrap up our deep dive into Walmart, always remember, folks, this is for informational purposes only and is not financial advice. Investing involves risks, and you should always do your own thorough research and consult with a financial professional before making any investment decisions. Thanks for tuning in to Am I Catching a Falling Knife? I'm your host, Dave, and I'll catch you next time.